I'm Steve Miller, and I have something I want to tell you. Recently, China, they had a devaluation. There's a lot of talk that they're trying to export their deflation as their economy slows down, and also fear that there'll be a currency war. In other words, other countries, they might want to lower the value of their currencies to fight back. Central banks, they act to lower the value of their currencies because they want to stimulate. There's several ways that they can do this, of course. They can print money. We've seen a lot of that in this country through QE, quantitative easing. They can buy or sell the currencies and try to push them some way in the open market. Or they can plain out devalue, like what happened this past week, in China. Problem is that they all want that. They all want to lower their value of the currency because they all want to try to stimulate their economies that way. All the central banks, all the governments. Well, they'll do that unless inflation becomes a problem. So they blame China, a 4% devaluation. They're the devil, right? Well, the real blame goes to the United States. We're going to look back at some charts and you can see that they started it. I'm going to put up several charts right here. And the first one is that of the U.S. dollar. Let's take a look here at this chart of the U.S. dollar, and you will see that. This shows you back in 2002 where the U.S. dollar was up at 121, and we had that dot-com bubble back over there, the stock market being pushed up. Greenspan then, as the market started to decline, pushed interest rates all the way down to about 1%. And then, of course, in 2007, it was Greenspan that handed it off, the same policy, to Bernanke, essentially. And Bernanke did the same thing, and they annihilated the value of the currency. I want you clearly to see that there was a 41% loss in the value of the dollar back from 2002 through 2008. Pretty big decline there. So that was the U.S. that pushing down the value of their currency. Well, let's say the world wanted to compete. They wanted to stimulate too, right? So take a look here at the next one. Here is Japanese yen. Take a look at it from 2011. They actually really wanted to push their currency down because they have Abenomics, this triple arrow bunch of garbage that is essentially the ultimate manipulation. And look what they did to their currency, 30% loss. So taking turns in this stair-step downward move. Take a look now at the euro currency. Yeah, what do you think? 2014, 2015, they couldn't stand having the other currencies so cheap, so they're not competitive. What did they do? The same thing, 25% loss in their currency right there. So what happened was, for China, they kind of suffered. The dollar rebounded off of that move, as you saw in that chart. And China, well, their yuan is pegged to the dollar. So as the dollar rebounded, their goods became less desirable. The value of their currency went up, and so that they had to take some action and devalue the currency. So when you devalue currencies, what happens is that you end up getting the buying power goes down, and asset prices, well, they can tend to go up. Let's take a look now at another chart. I'm going to put up a chart of gold right now, and you will see that this chart shows you that, well, while the U.S. was killing its currency, where you saw that big 41% decline, look what happened to gold. Gold rallied 675% during that same period. Of course, because the buying power of the currency goes down. And they're all doing that now, stair-stepping their way to oblivion as the central banks, the ultimate manipulators and governments, try to push down the value of their currencies. But it's a stupid game because they're all doing it. Yeah, the gold has had a bear market here, lost 44% of its value. But you better believe that before you know it, there's going to be another big up leg here in gold, because, well, you can't just keep killing the value of the currency and expect asset prices not to go up. In fact, we saw that here in the U.S. as the stock market, well, went up in a big way, all based on an interest rate a bubble, and all based on a earnings bubble that was caused by these low interest rates. So right now the stock market is turning weaker, and that is going to be an issue here. So there are risks to all this game that they play. Imports, well, they become more expensive when you lower the value of your currency. So what happens is that, well, factories don't sell as much because they don't expand. Their productivity falls because they pay a higher cost of input for the goods that they have to bring in. So that actually causes a slowing in the economy. What you give to the exporters who are going to benefit, you take away from the importers. So it's where do you get when you do that? The cost of goods goes down for the exporters, demand goes up, and then prices go up too, so you get inflation. The cost of goods to the importers, well, that goes up, and that's more inflation. So yeah, you lower the value of the currency, you get inflation. That's what they want, of course. They want to stop deflation, but down the road, this inflation mounts, and it becomes, well, a big problem. There's also the risk of protectionism and trade wars as they fight in this currency war to keep the value of their currency low, and they fight to keep their goods getting sold at reasonable prices. It's this part of a stupid game that they continue to do. Essentially, the falling currencies, all of them cheaper from the major economies, that kills the emerging markets, and we've seen these emerging markets get hurt also. These are the major manipulators, the governments, the central banks. They bring these false rallies that we've seen like in the stock market and big bouts of deflation, well, like they're afraid of right now, like we saw here in 2007 through 2009 here in the U.S., like we've seen continually going on in Japan for 20 years and more, and struggling in the European markets to get inflation coming in. It's because they keep manipulating these currencies. We need free markets in order for us to get organic growth and a real sense of value in these markets and currencies. You know, since 1913, when the FOMC started here in the U.S., the U.S. dollar is down 97% in buying power. 97%. They keep doing this, well, your money is going to be worth less, and your kids will get the money from you with far less buying power, and a country that is burdening them with a massive amount of debt. You can help, actually, by not voting for the establishment leaders, not voting for anybody who isn't a free market leader. They will then put heavy scrutiny on these central banks, and we will see a much, much different environment. We need to have that type of leader now, and you can make the difference by the ones that aren't free markets. Vote them out. And when you can, rant, rant, rant.